Welcome back to the Dividend Diplomats YouTube channel, everyone. Lanny, Bert, the Dividend Diplomats. Today, we're going to talk to you about the 5 worst performing stocks of the Dow Jones Industrial Average in 2022. Those dogs are barking, and that's what we're going to talk to you about today.
But guys, before we do, we are trying to reach the millions. And millions of dividend investors out there, Bert the Hurt and Lanny over here with the Diplomats. Make sure to hit that subscribe button, give this video a thumbs up. We got to get into it because we're talking about 5 dividend stocks, or no, not even dividend stocks, 5 of the worst performing stocks, period. Dividend or no dividend.
Foreshadowing. That's right. So we know what's happened in 2022. It has been an awful, awful year for stocks and the equity markets. S&P 500 is down 25% year to date. The Dow Jones, which features 30 blue chip stocks, is down 19% year to date. So we all know one of the things people love to follow and people love to talk about are those dogs of the Dow. Which ones from the previous years are the worst performing stocks, buying them, and then seeing their price appreciate over time. There is a strategy out there for buying those dogs. The one thing though, some of them pay dividend, some of them don't. And because we are dividend growth investors, we're just going to highlight the 5 worst performing stocks, those 5 dogs, and just see, is there any of them that are catching our attention?
So guys, this is going to be a fun dividend investing video, a fun investing video. So if you're a beginner investor, definitely keep your ears glued to this because you might want to pick up a couple of these dogs of the Dow. Again, 5 worst performing stocks through October 14th. Bert, how do you want to start this bad boy off?
So I think we'll start with we'll do it in reverse order. Which one's the 5th worst performing, the 4th worst, and we'll go down to the worst performing stock.
Let's do it.
Yeah, and when we do it, we're just going to talk about the metrics of the. Yeah, I know. We're going to talk about the metrics. We're going to run them quickly through the Dividend Diplomat stock screener. The 3 metrics are 1, PE ratio less than the S&P 500. 2, payout ratio less than 60%. 3, dividend history. How long have you increased your dividend for? How many years in a row? And what's your average dividend growth rate? And then there's that bonus metric, the dividend yield, baby. We're going to run in
threat.
Yeah, the triple threat. And then you have the person coming off the top rope when you're done there. So, all right, Lanny, we're going to talk about these companies. This will be funny because we definitely own a few of these dogs. Let's start with that 5th worst performing stock. What corner are we heading to, Lanny?
We're heading on the corner of dog crap right now. But guys, it's a dividend aristocrat. Over 48 years of growing their dividend. We're talking about Walgreens, Boots Alliance, ticker symbol WBA. They were once trading at 50, 45, 40. 35. Now they're trading below $35 a share, and I might have to just pick my wife up a share at this darn price. But they were trading at $33.24, down over 37% this year, just losing market cap.
Yeah, and remember, everybody, the overall Dow is down 19%. So we're already at the 5th worst performing one, doubling the negative performance here with Walgreens, Boots Alliance. Yeah, it's been a tough year for Walgreens. The turnaround story, the growth just hasn't happened as expected. So the COVID boom that helped bolster their financials over the last few years is kind of dwindling a little bit. So a lot of headwinds facing Walgreens. Their current price is $33.24, forward earnings $4.55. Their PE ratio is 7.31.
And on Thursday, October 13th, I'm pretty darn sure they just reported their fiscal year 2022 earnings. And guys, they had a 4th quarter loss, not net income for that quarter. So just a heads up from there.
Yeah. So let's look at that payout ratio, because you hear that, you hear sliding price, you hear net loss, you think, what's the safety of that dividend? Their annual dividend is $1.92. By that, by the expected forward annualized earnings of $4.55, that's a payout ratio of 42%. So at least they have a low dividend payout ratio here, Lanny.
They do. And you know, on the year though, guys, I do also want to just make a note that they did earn over $5 in earnings per share. As you'll see here, that dividend is extremely safe, as Bert just indicated. But to look at that third metric, dividend growth for Walgreens, guys, no question, 48 years on their way to being a dividend king. They will become a dividend king. Again, no question there. But they increased it at a 4.63% rate, and that's been a very low growth rate over the last few years, and don't anticipate anything big for at least another year plus.
No, I would agree with that. And we mentioned, yeah, they're almost a dividend king. So they at least have that long-term history. Let's look at that yield now. With their stock falling 37% year to date, that yield is swelling, Lanny. It is not 1%, not 2%, not 3%, not 4%, not 5%, almost 6%. Their yield's at 5.78% at the most jinkies. So,
Wow.
yeah.
Wow.
So, I mean, everyone, yep, fifth worst performing. It shouldn't really surprise too many of you. We'll just put the summary metrics up here. We don't need to re-highlight them. Lanny, you want to take us into number 4 right here?
Guys, let's head out to the West Coast or the East Coast, because we're looking at Disney, ticker symbol DIS, down almost 40% in 2022 alone. They have not resumed that dividend since they completely not just cut it, but demolished it to zero. So they removed their dividend as they were trying to conserve cash flow, conserve cash in general. And that was back in 2020 during the pandemic, as amusement parks, et cetera, were shut down, and they were pouring money into Disney Plus. Is that what the platform's called, Bert?
Yep, it is. Yeah, and I mean, that's such an important point for why they cut the dividend. That's the thing that people love about Disney, how much that they squeeze out of their content through the amusement parks, through Disney Plus, through the merchandise. Yeah, when you lose a year and a half,
the merchandise.
Yeah. Can't get those Mickey Mouse ears if you can't go to the amusement park to get them. But yeah, when you can't go into the amusement parks for that long period of a time, of course you have to cut the dividend to do that. But there's going to be hope one day that they'll bring the dividend back, and we'll see when that is. I can't predict it. Nobody can really predict when the dividend's coming back, but it's worth eyeing them because they are the 4th worst performing stock of the Dow. Walgreens was down 37% as a benchmark, everybody. Disney is down 39.75% year to date.
Bring it back, or sweet chin music is still going to continue to play for that stock. But Bert, enough about Disney. Disney shareholders have been waiting already patiently. But what about this other company that I don't think anybody anticipated being on this list? Take it away on the 3rd worst performing Dow stock, or stock of the Dow.
Yeah, we're really jumping in the worst performing here because this company is down 44.33% year to date. The ticker makes me laugh though, because it's not one of those ones where the ticker there is just hits right to what the company does. This company is Salesforce, ticker symbol CRM. So it's another non-dividend paying stock on here. Salesforce is getting absolutely slammed. And I think it's interesting with this company as they continue to make their acquisitions. They're trying to fight Microsoft. They're trying to ingrain themselves in these companies, sell their products. Because you know what's not cheap, Lanny? Salesforce licenses. I could tell you that for a fact just from from the place we're at. It is not a cheap product to use. And once you're in, it's very hard. The stickiness of Salesforce and to break free from that is very difficult.
Highly integrated into many core operating systems at all types of industries. CRM, it's very funny that that's their ticker symbol for, client or, relationship management, or whatever you'd like to call it. And trading at 142.22, forward EPS is 474. So they have a P ratio of 30. So very expensive still in this market right now, but it's a growth stock. It's a tech stock. So take that for what you will.
Yeah, that's the funniest part. PE is still 30. So it's not as if usually when you're looking
I'm 40.
Man, give us a thumbs up if you still know that reference. I would love to know how many people know that clip that we're talking about there. We're not going to put the GIF in this one though. So, because we're going to make you see if you know that. So let's move on. We're out of the non-dividend paying dogs of the Dows. Let's get back into the last two, which pay annual dividends. That swoosh, Lanny, is number 2 of the worst performing stocks of the year. Nike, ticker symbol NKE. They are what would you say, tombstoned on this one or pedigreed? This one
Well,
might
what it was
pedigreed
a
number one.
spike. It was a spike tombstone. So
Yeah, it was.
The Undertaker had him up, and somebody came down and spiked their feet down as they went down. That's you probably don't even know about the spike tombstone, do you?
No, I actually don't. I'm gonna have to look this one up after there because
Yep. Spike
yeah,
tombstone pile driver.
yeah, because that one is brutal. They are down 46.83% year to date.
Yeah, I mean,
But
brutally beat up.
what's
Brutal.
interesting for Nike, this is one that it'll be interesting going through our stock screener because their yield has always been so low for the longest time. With this 46% drop, though, that's the question. Is it time to consider Nike? Let's look through the metrics to see how the rest of their metrics are performing here. Their current price is 87.55 cents. EPS 297. PE ratio is 29.48. And I laugh because that's not cheap.
Not cheap. Definitely, 10 plus over the S&P 500 right now. So a pretty expensive stock because of poor analyst expectations right now.
Mhm.
I know there are a lot of investors that, oh, stock's down 47%, time to jump in. I'm not here to say no, because it's a great time to buy Nike simply because the 5-year average yield is 0.97%, and they're currently yielding 1.39%. Again, that's a little bonus metric.
Yeah.
So again, it could be a good time, but there could be more pain to come possibly, but they've always traded a higher PE ratio.
Yeah. And that's what's interesting about looking at the dogs of the Dow and looking at this strategy. And just to rip through the other metrics, their payout ratio is 41%. So it's a pretty safe dividend. It's in our perfect payout ratio range. 5-year growth rate's 11.12%. And they've increased that dividend for 9 years. So they're working towards becoming a dividend aristocrat. So a lot of the metrics check out if you can get over still the high valuation. That's
Yeah.
personal
Great.
investment strategy.
Yeah, great dividend growth rate, solid dividend yields less than the S&P 500. So again, take it for what you will. But Bert, that was Nike, that was the NKE, that was the Michael Jordan, LeBron James pump brand right there. But there's been an even worse performance stock.
The number one worst performing stock.
Number one.
Yeah, Intel, ticker symbol INTC. I know. I didn't know if we were going to have one that crossed this threshold, but Intel is down 51% year to date.
Well, 51% dividend yield, almost 6% on Intel, which is unreal at 5.63%. You guys have seen us talk about Intel in many videos. Payout ratio is still safe below 60%. PE ratio is 10, growing the dividend for 7+ years at 6%. Intel just can't get off the ground right now. I'm about to bring my shovel down to Columbus to start building that plant with them just so they can start making chips, darn it.
Do you need some help with this plant, please?
Do you need me?
All right. So we'll do the 2 honorable mentions here before we summarize the top 5 again. Number 6 and number 7 are Cisco, down, ticker symbol CSCO, down 36% year to date. Their yield has jumped up to 3.78%. Number 7, 3M, ticker symbol MMM, down 36% year to date, and their yield has jumped up to 5.25%.
So how many dogs of the Dow do you own out of the 5, or including the honorable mentions out of the 7? Bert, how many do you own of these?
The 5, Intel, Walgreens, 2.5. I'm hitting 40% here in our 5 list, and then I own both of those honorable mentions. So my batting average jumps up when you consider those 2. So 4 for 7 from that. And what about you, Lanny?
Right there with you.
All right. Well, we're in this journey together. Let us know, everybody, what are your thoughts about these dogs? Are you buying them? What are your thoughts about the whole investing in the dogs of the Dow strategy altogether? We'd love to hear that in the comment section below.
If you haven't already, definitely subscribe to the channel. Give this video a thumbs up. Let us know what stocks you're buying to build passive income, to reach financial freedom, because we are all in this together. Bert, any other parting words, my man?
Send these suckers out of here, Lanny.
Guys, that was Bert, the Hurt, and Lanny from the Diplomats, over and out.